Welcome to the Ideal Investor Show. This is the podcast where we help you challenge your mindset and discover where you are. Tired of stories about other people's success? We can help you change your life, determine your time freedom point, and join us on the journey to financial success. Let's go. Hello and welcome to another episode of the Ideal Investor Show, where we bring you people that help us passively invest, develop passive income, ultimately reach our time freedom point. And there are a lot of different ways to get there. And so we are very grateful today to have Charles Carillo with us from Harborside Partners, who will tell us a little bit about one of those ways. Charles, welcome to the show.
Yes, thank you so much for having me on. It's great to be here.
Yeah, wonderful. Thanks for making the time. So before we dive into exactly what kind of investments and how you actually help people invest in real estate, tell us a little bit, how did you end up in the position and in the role that you're in today?
Yeah, so just a little background on myself. I'm originally from Connecticut, a small town there, and my dad has been a multifamily investor since 1984 in a city about 15, 20 minutes away from where we grew up. And it was, I think he started with like a 6-family, and he grew that into the late 90s with partnering to about 100 plus units. And they were really most of them were in like a D, C- type area, like really bad area. And so it was something growing up. It wasn't something that I was very interested in getting involved with. Coming around like to high school and college, I really realized the whole passive income thing, and put that two and two together with my dad's lifestyle over all those years, and then also with the freedom. And it was something that once I got out of college, my dad kind of pushed me. Now we call it house hacking. But so when I got out of college in 2006, my first investment was a 3-family, what they call now house hack. So I lived in one unit, I rented out the other two, and covered the majority of my mortgage and payments, and that was awesome. And that was at the end of 2006, which was a very interesting time. And then the end of 2008, much different time. Bought another property there, another 3-family. And then in 2009, I bought my first commercial property, which was a small mixed-use property. So it was like, office on the first floor and rental units above it. And I self-managed all my properties for about 6 years, and then moved down to Florida in 2012 and had a third-party manager put in charge there. And since being down in Florida, over that time, we've purchased larger properties, and then we've been involved with syndication since about 2018. And that's where I stand now, with working with passive investors to invest alongside us in our syndication properties.
That's very cool. Now, I also saw, and I don't know if that was for you and your partner or together or separate, that you did like 40 countries and 47 states. How does that fit in?
Before I went full-time in real estate, which was around 2018, 2019, I was running a payment processing business that I'd started with my brother. And we had a lot of clients that were in mainly Eastern Europe. And so I would spend like 2 months a year in Europe. And yeah, I was able to do a lot of traveling there. And my wife used to work 2 months abroad in Hong Kong. So, I did a lot of traveling in Asia as well, too, with all these different kind of remote positions that we were working in at the time. But yeah, that's how you're able to do it, especially when you're in Europe. I mean, there's so many different countries so close to each other. I mean, you can really, it's not like you're here in the United States, you got to drive 25 hours just to leave the country. You know what I mean? Especially from Florida. Yeah. So you can go an hour and go into a different country. So, but yeah, it's great. Everybody has their own different kind of customs and cultures, and it's awesome to be able to experience that.
Yeah, absolutely. It was actually reminded me because I'm originally from Germany, and I used to do a little bit of business on the East Coast in the New York area. And, when you're in California, it's, unless you go east, it's several hours and then you leave the state. But up there in the New York area, it was like a news sign all over the place constantly. I'm like, oh, this is a little bit more like Europe, where the states are really not that big, so
yeah.
Cool.
Yeah.
So you said then you basically got to Florida and you started to get into syndication. Tell us a little bit, what kind of properties are you currently working with, and how can people actually generate passive income from that?
Yeah, so getting involved in 2018 with syndications was really the only way that we were able to really scale up our business. And I had people asking me, some business partners that want to invest, because I've been doing at that time 12 years or so, and they wanted to invest alongside me. I never knew the correct way of doing it. You know what I mean? It's always a gray area if you're taking money, you're trying to set up some sort of partnership. And so when I aligned with a group when I was living, my wife and I were living in St. Petersburg, and we working with a group that we still work with today in Tampa. And we purchased a 59 unit building, and we raised money, raised just about $2 million for that property. And we held it for 3 years and sold it. But when we were doing that property, that was allowing us to bring in passive investors that want to get along, want to really, let's say, diversify their portfolio into real estate. But some of them weren't even in the country that were investing. Some of them were expats. Some of them were in the country, but just didn't have any knowledge of doing the active real estate investing. Because as you know, I mean, it's a lot of work becoming an active real estate investing. We're not even talking about buying it, just preparing to purchase property correctly as an active investor takes so much time, from building the teams and finding the markets and everything like that. So that was something that getting involved with that allowed us to do that. And since then, we've changed we've changed really what we focus on. We've been focusing over the last 3 years on purchasing B-class properties only. We used to do a mix of C and B. So we're buying better properties in better areas, buying properties that are built in 1985 or newer. So really kind of narrowing down our quote unquote buy box of what we're purchasing. And now we really focus on 100+ unit properties. Our last property was our biggest yet, which 536 units, but the one before that is 157 units. So we're all in that 100+ units. That's where we're able to get scale, and we're able to kind of eliminate a lot of the volatility, because in these large projects, with 150 units, you have 150 people, 150 income streams that are paying you every month. So if you have a person not paying or a problem here or there, it allows you to, number one, have a great source of on the boots on the ground, boots at the property, handymen and administrators that are there handling renting, handling any issues. And then the second part of that as well is that you're able to turn the units quick. And then the third thing is that you're able to really, that's the ability to really scale. You know what I mean? And you don't really have too much issues with volatility with that many income streams on a property.
Yeah, that totally makes sense. Now, do you guys in your box, like you called it, do any kind of forced appreciation or stuff like that?
Yeah. So how our business plan works is that we will have a value add component to every type of property. And the value add component is really just we want to go into a property. And when we're looking at the property, over, just to say the 30,000 foot view is really, you're going to a property to be able to raise rents. I want to look at the property and I want to see the ability to raise rents by 25% or somewhere around there, right? At least 20%. And that allows you to go in there and actually make the deal work. And how we do that is not just by going in and raising rents. When we say value add, you're going in there and it's really increasing rents by 25%, but also on the backside, and this is over maybe like a 3-year or 5-year period. On the backside, we're also going to be switching out vendors. We're also going to be minimizing expenses, really changing over the whole management of the property. We don't keep any of the management when we purchase. We put our own management in there that we've worked with in that area. And we're working with them and with also our trusted vendors in that area. So really, you're going in there, you're changing up management right away. When you're changing over management, you might have, the longer people own properties, the more lackadaisical they get on it. They're not as focused on having tenants paying on time, or raising rents or keeping with market, you know what I mean, pricing. So in that situation, when we go in there with our new management, we're making a focus on that. People that aren't paying, they're out. We're renting to good tenants that we're putting through a full screening process. And then also the second part, the main part of the value add portion is that we are going in and we're actually doing work to the units. So we're going to go in there, we're renovating the units. There's going to be a lot of deferred maintenance. You're going to have interior and exterior. And when I say exterior, really like common areas. So you might have in your hallways, you're going to have it outside in amenities. You're going to have it possibly deferred maintenance, just like roofs and other things that need to have attention. So we go in there in the first year, we're really going in there and completing and fixing any type of common area, deferred maintenance. And then what we're going to do is little by little, we're going to renovate the units as they become available.
So when
And
tenants move out, then before you put new tenants in, you do the renovation. One thing that I'm always been kind of curious, and I wonder, when you take, let's say, a 100-unit property, are you basically saying, okay, current purchase price, I don't know, let's just say 5 million or something like that, or I don't know what is a reasonable purchase price in that category?
yeah, so it's really our last property we purchased at about $109,000 a unit. So
Okay, so yeah,
you're
let's say,
talking, yeah.
or 10 million, just to make it a round number. So you have 10 million to buy the property, but if you want to do those renovation works and improvements and stuff like that, you probably need to budget for that as well. So my question in that context is, when you bring in the investors, are you basically saying, okay, we know we pay 10 million, we need probably 1.5 million or 2 at least in the beginning to do the improvements. So we are collecting that amount of money in certain increments from investors, or do you also take on any kind of lending?
Yeah, that's a great question. How we're financing what we call the CapEx, which is the capital expenditures for doing the work. And
Or the whole
yeah,
thing, kind of, in a
yeah,
way.
yes. So using your example of $10 million, you're typically going to be, we're probably going to be putting down somewhere between 30, 35%, somewhere in this area, and 25 to 35, let's just say. So you have $3 million there they're using for the down payment. You give some closing costs in there. So you're at like, 3.5 million. So at that point, we're probably going to be raising on a normal property. You're probably going to be raising somewhere in the neighborhood of, let's say, $4.5 million, say $10,000 per unit. Probably 5 or 5,500 of that is probably going to go into interiors. And then you're going to have the rest of it going for doing, resurfacing, seeing the pool, doing over the gym, these type of amenities like this that aren't inside the unit. And then you have some roofs to take care of, stuff like that. So yeah, you're looking at that. So when you're going to it, you say it's a $10 million property we're purchasing, and we're going to raise, $4.5 million for this property, and maybe four and a half or five. We do have the ability with a lot of lenders of financing that, and we've done that before. It just depends on the lender that you're working with. If we are buying a property that is very undervalued, we might finance a portion of that through the lender, and we might raise the other part of it. So instead of raising $4 million, what we might do is we might raise just 3.5 or 3, and then finance the other part of it. And so that allows us. The thing though is that when you have that, you still need to have a great buffer, because you're going to have draws with it, and there's going to be a draw schedule. So, hey, roofs get done, then they have to send some out to inspect it, blah, 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 and then you get your money, which is great, because then I can go on to next project and go like that. But you also have to raise all of it, so you can't finance any of it. And working with certain lenders, especially ones that are government guaranteed lenders, insured lenders, they're going to be much more particular on what you're doing. So if you're going into a property and you tell them, there's 20 roofs at this property, and we're going to do 15 of them, and then your roofer comes out and says, listen, you only need to do 13 of these. These are fine. These other ones are fine. That lenders might have a problem with that. They're going to say, why didn't you do it? You lied to us about what you're doing. So now you have to go in there and you do it. So it's difficult when you're doing that. It's much different when you go in there and you're just getting money and you're like, hey, we're going to do some renovations here, because now they might say it's mismanagement, or you're cutting corners of what you told us with the business plan. If you're going into, say, a bridge lender or some sort of variable lender bank, they're not going to care as much. They want to see the NOI moving up. They want to see the property being improved, normal stuff that we would think people is. But when you're having different entities that are getting their fingers in it, that's one of the things, is that you need to, you really stick to that business plan and make sure that you're doing 100% of it. If you're saying you're going to do so many units renovated per year, and then you end up in a year selling it to someone you haven't done the work, you might have an issue with the lender, even though that everybody got paid. You know what I mean? If
Yeah,
you're dealing
absolutely.
with,
That makes sense. So if you were to put this in perspective of percentages, how much do the general partners put in?
Typically they'll put it somewhere around 20%.
Okay. I think that's important to know. So it's, you guys have skin in the game, the investors have skin in the game, and there may or may not be a lender.
Mhm.
So the other thing I wanted to ask, I mean, people oftentimes ask me, and I'm sure they're asking you as well, this categorization of real estate. And I know that it actually originally came from the commercial space, not so much in the single family or duplex area, but we kind of have adopted it too. But when you say, okay, we used to be in more challenged areas and now we're focusing mainly on B class, how much of it being B is really the location and how much of it is actually the property?
That's a great question. So the area is the most important. If you're going into a property, because you can't change the property, and we definitely can't change it or think we're going to change it in 3 to 5 years. Now, you go into an area you haven't been in 10 years and you see it's changed, yes. But many areas you go into, there might be a little bit of change, but there might not be a major change in 3 or 5 years. You might see some stuff updated, but you're not going to change that neighborhood. So going in and making sure that the neighborhood is actually a B or above area is number one. And then number two is really going in and identifying a specific asset that you're going to purchase in that area. And when you're doing that, you really want to see if you can find or how close you can find comparables to that property. And not really for purchase price, but really for what they're getting for rents. So if I'm going in and, we're going to buy a 1990 built property, and there's one next door that's 1989 built, and we see exactly they've done renovations 2 years ago, and they're getting rents that are 27% higher than ours or whatever it is, then we can go in there and go, okay, this is kind of the route of what we can follow. And now when we go in there, we can put that in our number. Maybe we'll lower that down a little bit and say it's 23 or 24. And then we're going to have a newer renovated property than what they have. But we know that getting to that number, because that's what they're renting at, is what we can do it.
Okay, yeah, that's awesome. And that is really a wonderful explanation. One quick thing. If you take the example you just gave, right, like there's a 1989 similar unit, maybe a little bigger, a little smaller, not too far away, and you can make that calculation that you just described. Why wouldn't the current owners, why wouldn't they do the same thing, see the potential, see the financials? I mean, one thing I always say is math is universal. It doesn't change. It's not different in Florida than in Alabama or stuff, at least, like fundamentally. So what's the typical reason that you find that I can see it for like a small portfolio or small properties a little more, that people just say, I don't want to do the work anymore. But on a 100-unit property, it's a professional commercial thing anyway. It's not like one person trying to keep a 100-unit apartment complex running. At least I would assume so.
Yeah, it'd be very interested to see. I mean, I've reviewed properties before with 200 plus units that were literally self-managed by someone, and they had like 2 people that worked with them, and it wasn't professional at all. But in the most part, what you're going to do is you're going to have an owner that's been there for a while. And let's just say that property is going for that $10 million now. And let's say that person, not saying they bought it, they built it, but let's say they bought it, 10 years ago, or even 6 years ago, 7 years ago. And maybe they paid $4 million for it, right? And they put $1 million into it. They have paid down so much of their mortgage. I mean, they might owe $4 million on the property that's now worth 2.5 times that. So it's something that when you're seeing those numbers and what they're doing for them, they want it. And you see this with even with mom and pop. It's the same kind of strategy as you'd have with mom and pop owners of small apartment buildings and also of, say, rental properties. I mean, I imagine you've purchased properties from other investors that had them for years. They hadn't raised rents. They got tenants in there that haven't had a rent increase in years. And these people are retiring off them. They're, you know what I mean? They bought it for 100 and now it's worth 400. So it's a similar thing. And it's not always the owners as well. It's also with the property manager. If they have a property manager in there and the owners are not kind of prodding them along to, hey, what do we do? What else do we have to do? How do we have to do this? Because to recapitalize the property, they're going to have to go into their own pockets to get that money just because there's equity there. So that means that they're going to have to refinance it. They're going to have to go into their own pockets, and they have to go and they're going to have to invest that $1.5 million to get the return. And most people won't want to do it. And they don't want to have the issues with the turnover with tenants as well.
Absolutely. And that makes a lot of sense. I mean, one thing that came to mind for me was, if you think about just a syndicator bought the property, like you said, for $4 million 6 years ago. It was in reasonably good shape in a B class neighborhood, because that's why you're there looking at it. If they were to say to their clients, hey, we can make 2.5x on what we bought it for, that's probably a good return, which only happens in times when we had a lot of appreciation. Then you come in and say, okay, well, but because you haven't really done anything in those 6 years that you've had it, now if we start doing something to it, then we can actually keep that progression of appreciation going. and make our investors happy, which kind of leads me kind of in a sense over the bridge. And I'm really, this is what I'm personally most curious about is, in a way, I think the proposition is, okay, I'm offering you to invest X amount of money for X amount of return for, let's say, 5 years, secured by real estate. So how do you find the people that are interested in that, and what are those numbers for the excess, for what is the X amount of investment and the X amount of the potential return?
Yeah. So when we're working with passive investors on our end, it's usually typically there's a minimum investment of about $50,000, and we always tell investors 5 to 7 years. That's really the window. Sense. Now, as you said, we've gone through a lot of appreciation, so those numbers have actually been a lot smaller. So it's in the sense of been shorter terms on their investments. So we've been able to hit projections in 3 years over the last few deals we've done. And, going forward, we always say to 5 to 7 years, because you just don't exactly know what's going to happen with it. So really going in, having the ability of increasing the value on the property. And that allows us, once you increase the value of the property, you have many different options. You can sell the property. You can refinance the property out. You can hold the property just as it is, depending on the debt that you have with it. So the main key is if we can go in and add value to the property, that's going to give us a lot of options with what we're going to do. We can also possibly 1031 the whole property into another one with all of our existing investors. And so they went from, a property that we bought for 150 units. Now we went into one that's, with the same amount of money that we bought for, 180 units. And now we're going to be able to go into a better asset, and they're kind of pushing back on deferring all their taxes. So there's many different ways if you add value. The problem is when people don't underwrite the property correctly, they're not hitting the numbers they're supposed to, and they possibly overpaid for a property. That's when the issues happen, because now you can't refinance it. You're stuck in a very tight situation, which with some operators will find themselves in where we are now and going into the future.
Yeah, that's very good. Now, can you put any kind of rough number on what the return expectation is?
Yeah, sorry. Yeah, so with doing that, when we're penciling out a deal, we're really shooting for, and every deal is different, but when we're looking at a deal, we really have to see a 15% IRR, 15% return per year on the property over the period that we're holding it. And we're also looking for an equity multiple of somewhere in the neighborhood of 1.5x, 1.7, 1.8x, something like that. So what that means is that if you're investing $100,000 into a property, we're going to be able to get our investors back out that, say, somewhere between $150,000 to $175,000 total. And let's say that's going to be somewhere between, as numbers, we're talking years, let's say 3 or 4 to 6 years on average, something like that. And obviously, the longer you hold it, the higher that multiple is going to go, and the lower that average return is going to go. But
yeah, that makes sense. And I mean, that's also probably to some extent a little bit dependent on the market, right? Like
exactly, yeah.
We have some market disruptions. I mean, for one thing, that's the reason I asked about the financing is because obviously the cost of financing has gone up regardless who the lender is. We haven't touched on it yet, but maybe you should just really quick say accredited. What does that mean? Just to remind people in the audience what accredited investors are.
Yeah, so we will work with both accredited and non-accredited investors, or also known as like sophisticated investors. And what that means is that accredited investors are going to have a net worth of $1 million or more, not counting the equity in their primary residence.
Right.
Or they make $200,000 as a single person, or $300,000 a year as a married person for the last 2 years. Now, a non-accredited person is someone that's going to be, or a sophisticated person is going to be someone that's they understand finance, banking to some level, right? Investing, but they do not hit those metrics. And the difference from when we're providing deals and doing deals is that you're going to have investors that are sophisticated investors that want to invest alongside us. Different deals will be available for different people. So
right.
You'll have some deals that come out that are going to be for accredited investors only. And those deals are going to be the ones that are advertised. So you'll see that or any kind of sponsor will put that on their social media, on their website, stuff like this.
Right.
When we're working with deals that are for accredited and sophisticated investors, we need to have a pre-existing relationship with every investor that we send out to. So we keep separate email lists for this. And it really just means that you have a substantive relationship with someone, with the one of the partners that is in the general partnership. So if my partner knows someone and I don't know them, that's perfectly fine. Um,
Yeah.
but they have to have a relationship with us before we have a deal. So if someone reaches out to us that's sophisticated and it's mid 2023 and we build a relationship and they see a deal in March of 2024 and they want to invest into it, that's fine. We have a substantive relationship and that'll be fine. The problem is that if we have a deal and we talk to someone, we can't provide them that deal to invest as an investor right away. And we have that all set up because how we do it is we've, over the years, because of all the SEC rules, we've set it up where they don't even see the deals until after a certain time period, after even engaging with our firm and speaking to us. So that way we avoid that whole issue.
Yeah. Right. Yeah. Now, maybe I'm overstretching a little bit, but is there a role for the club that you guys have to build that relationship?
Is there a what?
Is there a role, that the club has for building the relationship?
Yeah, so we what we'll do is it depends on if we meet someone that we don't know per se. What we'll do is we have a lot of information that we provide out to them to educate our investors, because a lot of people don't understand. They understand the kind of what syndication sounds to be and what it allows them to do as being a passive investor coming into larger properties, but they might not understand actually the nuts and bolts of it. So we educate the investor. That's the main thing that we're doing. We'll get on an intro call. We can explain to the investor how it works. We have a whole Dropbox folder area on our site that we provide to to new investors, to any investors, so they can learn the business. They know exactly what the offerings look like, what the actual timeline is. So when we're talking to someone, they know exactly deals are going to go out here. You have this much time usually to do your due diligence. Money's usually required in here. And so people have an idea and they know exactly. It's not going to be something where, you get an email and you got to invest tomorrow. So they have time to do their due diligence, speak to all their professionals. They know exactly what the investment offering document will look like. And this allows them to be educated, because the main thing is just the education. If we can educate you enough to understand exactly what the business is to a certain degree, obviously you don't have to understand, the nuts and bolts of property management, but you have to understand exactly what we're doing, and then know that, hey, there's going to be a legal document that comes out to you and all this kind of stuff that we're going to put together. Our lawyers are going to put together and send out to you, and you understand all of this. And that's the main thing that we're doing in that beginning process of educating them. And then while we're doing that, we're also building a relationship with them.
Yeah, that's very cool. And thank you for describing that in a nice, concise way. Now, you said about a bunch of times when they come to us, and this is my experience too. I love it when somebody comes, email or strategy call or something, and says, "Hey, I heard Charles and you on the podcast, and it's interesting, and I wanted to kind of find out a little more what you guys are doing." But in all honesty, that is typically the minority of cases. So I'm kind of curious, do you just, go on like Facebook, Twitter, LinkedIn and say, "Hey, we have these great properties. Don't you want to invest?" Or how do you actually find people like that?
So how we've been very good at finding people is that I have a podcast I've had for about 4 years, and we just did about 100,000 downloads last month on that. And we have thank you, and we have a YouTube channel as well that we've been adding to for many years. So do a lot of we do interview every week, and then I do what's called the Strategy Saturday, where I go through in a 3 to 7 minute episode about a different strategy or a different term within real estate to get people to educate it to that level, and kind of helping spreading real estate investing to other people.
Yeah, that's very good. I mean, we're doing the same. You probably do it with more intensity, so we can learn a little bit from you and hope that people say, "Well, I can see the expertise. Like, we've been around, we have gone through a couple of ups and downs and tricky situations," because there are so many, in my opinion, that make it sound like it's all easy. You just need to sign on the dotted line and everything happens automatically. And I think we both would agree that's not the reality. The market constantly changes, the economy changes, the valuation, the rules constantly change, and staying on top of that, I believe, is the most important thing for our clients, to be able to say, I can rely on the fact that if I have a question about this particular deal that I'm in, Charles can answer it because he's constantly on top of stuff, and the same for our guys.
Yeah, that's great. Yeah, the main thing I talk to investors about, and you see a lot of people, and I imagine in your space too, you see the same thing, is people sell this passive investing as kind of like they're investing almost into an annuity, right? That's going to pay them out monthly or quarterly. And if they're investing into turnkey real estate, or they're investing into a syndication, we are purchasing a business. And there's going to be great months, and there's going to be months where it's a little slower than our expectations. There's going to be all types of months throughout the whole thing. The main thing is really, number one, not losing the capital. Number two is getting to that ending, or somewhere close to ending equity multiple of what we said. And so during that path, you're going to see, monthly updates come out, and it's going to be, this is good, this is not so good, all this kind of stuff, that how it works. But the main thing is that we're making progress on the properties, we're adding value, and to get to that ending goal. So I think that's an important thing that people have to understand. Any type of real estate investing, you do it yourself or you do it with one of us, it's something that you are purchasing a business, big or small, and there's going to be ups and downs.
Yeah, absolutely. I think I totally agree with that. The other part is listening to us and listening to what you guys doing and how you're doing it. How can people get in touch with you?
Yeah, thank you so much. So our website is harborsidepartners.com. So if you go to harborsidepartners.com, you can sign up for our newsletter, which I do every Wednesday, that goes out with a lot of information. And it's really just a list of links to articles that I found interesting that you can just look through in a second or two and click on what interests you. And then also we have, if you're interested in actually investing with us or thinking about it or learning more about syndications, you can go to our website and fill out a form to invest with us, and speak to myself or one of our partners. And then what we'll do is we will provide you with our whole education folder, and you can learn more about what goes into really investing into multifamily real estate and passive syndications.
Okay, awesome. So that brings us to the last two questions I always ask, Charles. If you could meet anybody, who would it be and why?
I would say Benjamin Franklin. Thought he was a very interesting person in all the biographies I've read.
Okay, and would you ask him anything other than, "Hey, did you know that you are on the money that we're using?"
The $100 bill, yeah. I just really liked how he was apprenticed, and then he became and he followed his passion, which was going into science and politics. But the thing though is how he was able to become so important in our history of aligning himself with important people and really following his passions.
Yeah, absolutely. I would, if I were with you, I would probably ask, tell me what you think where this country is going to be in 50, 100, 200 years from now.
Yeah, it's changed a lot. Yeah.
Yeah, I wonder if you could ask this guy if that is really what they had intended. Yeah.
It's amazing when you think about how they set it up and what they did. I mean, it's amazing that it stayed this long. I mean,
yeah, absolutely. I also really think it's an amazing concept, but to draw conclusions from what their intentions were that influence our life today, I would want to verify it's really true,
Yeah.
Okay, so the last question, Charles, is if you had a time machine, you could go anywhere, forward, backward. You can't change, obviously, anything, but you could go and observe and be there. Where would you go and why?
I would love to go back to the Italian Renaissance, to Venice. I think it would be really cool at that time when they were doing the same thing, raising money, but going and doing shipping between at that time, or this time now, Turkey and Italy, and with the spice trade, raising money and going out and bringing back and paying investors and the whole 9 yards. I thought it'd be a very interesting concept of how they kind of came up with all that back in the 1500s.
Yeah, well, you could just, from Carillo, you just go to Charles Medici, and then you can do the whole thing.
Now we're talking.
Yeah, all right, cool. Well, thank you so much, Charles, for making the time and being a great guest and rolling along. So one more
Thank you.
Okay, how can people get in touch with you?
Yeah, go to harborsidepartners.com. All the links, all the information we offer there is all free, and take a look at it.
Yeah, awesome. And we're going to put that obviously in the show notes. So thank you, and maybe we can do it again.
Play.